You have to wonder what the Bank of Canada is supposed to do with interest rates this week when it meets on Wednesday. Inflation is still going up. Also, some of the shine is coming off the EV industry with companies like Tesla and Ford cutting back on production. And new laws are capping the interest rates that high-cost lenders can charge. But will this help or hurt borrowers? Today is Monday, January the 22nd, 2024. Let's get started with today's news. The big news this week, no doubt, will be the decision that the Bank of Canada will be making on Wednesday with its interest rate policy. But the most important part of that is, what does it mean as we watch for these signals on the timing of rate cuts, which are expected to happen at some point during the year? Pretty much across the board, it's expected that the bank on Wednesday will not make any changes. They'll keep the rate at the current 5%. The next meeting is then in March, but the odds are currently around 60% that the first rate cut is going to happen when the bank meets in April. The most recent inflation numbers that we saw coming out, though, just last week, that's going to sort of grow this consensus that it believes that rate cuts may be pushed back even further. I'm hearing June or even July of the coming year. Next week, the U.S. Federal Reserve Board, they also meet and they will be making their interest rate decision. They are dealing with pretty much the same headwinds that we are here in Canada. There are some differences, but there's also dwindling hopes there of earlier cuts. A lot of people have been saying that they may be cutting as early as March. Projections have dropped there. The odds are currently around 40% that the odds will be that the bank will be cutting in March, and that's down from 70% just a few weeks ago before the most recent inflation numbers came out. So what is going on out there that is sort of dampening or changing this optimism? The first most obvious thing to me is this inflation. And in Canada, inflation ticked up in December. It came in at 3.4% year over year. That is up from 3.1% that we saw in November. Another measure that the Bank of Canada watches closely is what's called the trimmed mean CPI. That came in at 3.7% year over year in December. And that was, again, above the consensus, which had the number coming in at 3.5%. So those are definitely headwinds to potential rate cuts. If we look to the U.S., one of the people there who actually has a vote on policy moves, it's a Cleveland Fed President, Loretta Mester. And in her opinion, March is too early for a rate cut because she wants to see more evidence. As I mentioned, she looks to the inflation rate and says that the rise in U.S. inflation rate, which went from 3.1% in November to 3.4% in December, she says that it just shows there's more work to do, and that work is going to take restrictive monetary policy. Adding to that sentiment is San Francisco Fed President Mary Daly, and she says that while I think it's appropriate for us to look forward and ask when would policy adjustments be necessary so we don't put a stranglehold on the economy, it's really premature to think that that's just around the corner. In other U.S. data, retail sales were up 0.6% in December from November. That beat economists' expectations. Consumer spending is about 2/3 of the economic output. It shows that Americans still are spending despite the higher interest rates. When we look there at the job market, it's also still on strong footing, it appears. The U.S. job market added 216,000 jobs in December, and the unemployment rate there was steady at the 3.7%. And as Bill Adams, he's the chief economist at Comera Bank, and he says the upside surprise from jobless claims was a reminder to financial markets that the Fed is assuming a stronger path for the economy and more persistence of inflationary pressures than would be consistent with 6 interest rate cuts over the course of this year. Now, shifting back here to Canada, there is a bit of a conflict with the U.S. numbers. And for example, in November, Canadian retail sales came in lower than expected. This shows that the higher interest rates that the Bank of Canada has put on us are continuing to put a strain on consumers. I would say in some respects this is good because it does show that the Bank of Canada's rate tightening policy is actually having the intended effect by slowing economic activity. Again, though, we did see inflation actually rose last month, so that makes it harder for the Bank of Canada to make any reductions, certainly at this point. So this is kind of where we go full circle. We can see that most of the impact of higher interest rates is probably starting to settle in. It's having a negative effect on the Canadian economy. That sounds bad, but it's actually good as far as this battle to start dropping interest rates is concerned. Most analysts are, in fact, expecting Canada's economy to grow at a very weak pace in 2024. The good news here is that if this does continue, and if those inflation numbers do start to come down, the Bank of Canada will be able to start cutting rates, which will then, of course, help the economy start the next cycle and start picking up again. There's some interesting news coming out of the EV industry lately, which is just adding to this growing mindset that the demand for these vehicles at the current prices is less than what most of the governments around the world, and of course companies who build the vehicles themselves, are actually hoping for. First off, there will be a lot of focus on deliveries when Tesla reports its earnings this coming Wednesday. It has recently made a number of pretty sharp price cuts. They've also announced that they're going to be halting production at its Berlin factory. Earlier this month, Tesla slashed the price of its Model Y SUV in Europe and China. According to a report by Visible Alpha, expectations are that although Tesla is expected to deliver around 2.19, let's call that 2.2 million EVs this year, that is a 21% increase from 2023. They point out that it's still well below the long-term target that Musk had set about 3 years ago, that being 50%. In similar industry news now, Ford has announced it is going to be shutting down one of the production shifts at its Dearborn, Michigan plant. It's citing lower than anticipated demand for its F-150 Lightning pickup truck, their EV offering. This also mirrors a recent announcement from General Motors, which is postponing production for its Chevy Silverado EV. Now, Ford says it is still expecting an increase in Lightning sales this year. That follows a 55% jump last year, which resulted in 24,000 trucks being sold. They haven't given a specific expectation of how many vehicles or trucks they expect to sell this year, though. Now, if you wonder how those 24,000 sales of the new EV truck are compared to its legacy gas-powered trucks, well, last year Ford sold more than 750,000 F-Series trucks for the course of the year. So that obviously dwarfs the 24,000 demand in EVs. Chief Executive Officer Jim Farley, he, of course, maintained a positive view on the overall EV path. And he says, "We see a bright future for our electric vehicles with specific consumers, especially with our upcoming digitally advanced EVs and access to Tesla's charging network beginning this quarter." This episode is brought to you by our sponsor, Harvest ETFs, where they believe in building and preserving wealth through long-term ownership of high-quality businesses. Harvest offers a whole range of options to suit your needs, your goals, whether you want equity, enhanced equity, or fixed income. With Harvest ETFs, you can benefit from their proven three-step process. So they pick the best growth industries, then they choose the top businesses in those sectors. They boost their returns then by generating income through covered calls. Plus, you can actually get leveraged exposure to some of their ETFs for even higher potential returns. For those of you who prefer fixed income, you can invest in U.S. Treasury ETFs with covered calls, again, for high monthly distributions. Or if you want to invest in growth industries and major trends without call options, you can opt for their equity growth ETFs. So whatever your preference, Harvest ETFs has you covered. You can visit harvestetfs.com or click the link in the description to this video to learn more. A quick reminder, commissions and management fees and other expenses may be associated with investing in Harvest ETFs. Their values change over time. Past performances may not be repeated. Please read the relevant prospectus before investing. In our weekend edition of the Pulse newsletter, the poll question this week was, have the S&P 500 gains over the past 3 months confirmed we are in a bull market? So far, 55.21% of the votes are saying yes. You can weigh in by visiting our Pulse homepage, casting your own vote in the January 20th edition. Based on upcoming changes that are brought forward by the Canadian Finance Department, we can soon expect lower interest rates to be in place for some of the most expensive forms of debt that's available to Canadians today. The upcoming changes will see the maximum annual percentage rate that high-cost lenders can actually charge drop from the current 47% down to 35% per year. There will be an exemption for payday lenders who can charge a maximum of $14 for every $100 borrowed. Now, not surprisingly, the industry itself is kind of pushing back on this, but not for the most obvious reasons that you would think. You think it's just they want more business, clearly. It's warning, though, that the lower rate cap is going to result in possibly millions and millions of customers actually losing access to credit. Advocates are lobbying for better alternatives, which include possible government-backed offerings from Canada's big banks. Now, Jason Mullins, he's the vice chair of the Canadian Lenders Association. He's warning that as a result of these changes, many borrowers may no longer qualify for the new loans. And he says a meaningful number will get declined for a loan and, of course, have to turn to much less desirable sources. There is, of course, a group of people who are advocating for these changes, and that includes Donna Borden from the anti-poverty advocacy group Acorn Canada. She says It's better than it was, but if someone takes out a larger loan, the 35% is going to be really high. And she adds that in addition to the lower interest rates, the fees and insurance that are included should be included in the max, and this would also result in significantly lower costs. She cites an example that she experienced personally where she had taken out a loan for $10,000 at some point in the past. She paid back $24,000 on that $10,000 loan and found that she still actually owed thousands more. So that shows you how this type of loan can be very detrimental. She says this type of loan program just forces people that are in debt already into a debt trap. Even though they consider themselves that they're helping people, they're not helping people. They're putting people in a bad financial situation into worse financial situations. For the government's part, they estimate that this lower rate of interest is going to save borrowers about $26 million a year over 10 years, with part of that reduction coming from approximately 44,000 fewer borrowers. I will put a link here for our Pulse newsletter, which we publish every weekend. Go ahead and vote on that bull market question I have in this week. I'll also put a link for our Investing Academy. As always, thank you for watching this video, and we'll see you on Wednesday.